Welcome to the Transparent FX Academy. I'm Nick and I'm a top author in TradingView with over 190k reputation points. In this tutorial, I will be speaking about a very important topic. So make sure that you stick throughout the video without skipping any part because this will be a very important video. So without further ado, let's jump straight into it. This tutorial will be about liquidity traps. It's a very important concept that you definitely need to know the basics of, and that is exactly what you will get in this tutorial. Actually, you will be getting more than the basics because we will go in detail and discuss exactly what liquidity traps are, why they happen, so you have a clear understanding. I will also show you real chart examples of a liquidity trap which actually just happened and how a lot of traders got their stop losses hunted from this liquidity trap and how to spot them in advance and actually use them to your advantage. So this will be a very complete tutorial, so make sure you don't skip any parts and follow through until the end. So let's get right into it. So what are liquidity traps and why they happen? Well, liquidity traps happen because, as you know, in the market, for every buyer, there needs to be a seller. For every seller, there needs to be a buyer. And as we know from the institutional positioning, institutions have huge amount of orders and huge volume. It's not the same for them as for us to just press a button and the order is executed. Because there needs to be enough liquidity in the market to actually absorb that order. Now, if there isn't enough liquidity in the market, what usually happens is stop loss hunting and essentially liquidity sweeps. Now, what are liquidity traps and liquidity sweeps? Well, they are essentially the stop losses of retail traders which are providing liquidity in the market. Because let's present here an example. Let's say institutions want to buy AUD USD, but there isn't enough liquidity in the market for them to actually buy. Well, as we know, if retail traders are buying and they have a stop loss, the stop loss is actually a sell order because it is the exiting from the buy order. So if the price drops and the stop loss gets liquidated, that creates a huge liquidity event because many stop losses get all triggered at the exact same time, providing a lot of liquidity in the market that then institutions can absorb and actually buy. Use that liquidity to take the other side of the market. So that is why liquidity traps actually happen. And we can see here on AUD USD that we just had a massive manipulation and liquidity trap. We had a huge push to the downside. All retail traders that had their stop losses placed below these lows got liquidated, and then the price actually reversed to the upside. We can see that even more clearly if we go down here on the daily time frame. We had a huge drop to the downside. All the stop losses that were placed below these lows actually got triggered, and then the market reversed to the upside. And at the exact same time, institutions were buying, as we will now see from the commitment of traders. But that is something that I will be speaking about in just a few moments. The first important thing that we need to really understand is, before going in a real chart example, is how to spot these liquidity traps in advance. Well, actually, we will be discussing these two things in the same moment because we have the luck to our side because one of these liquidity traps actually just happened here on AUD USD. So we can take the real chart example and use it to explain the concept. Well, first of all, liquidity traps usually happen at very important historical levels of structure. So, for example, here, this level here was a zone from which this massive rejection to the upside had happened in the past, right? We had this massive push to the upside. Again, here the market tested its zone and rejected it to the upside. The market was testing the exact same zone again. So levels at which there is a historical attention from a trader's perspective. So both retail traders and institutional traders are looking at the same area, that is usually the zone at which we see these liquidity traps. So retail traders, after the first push to the upside, they most likely were already looking for longs. So first rule, these things usually happen at historical levels of structure. The second rule is how do we spot them? Because it cannot be that every single time that the market is testing such level, we actually have a liquidity trap. Well, the second thing that we have to check is, are institutions at this level actually buying? Because if institutions are buying, then there is an increased probability that, first of all, that level of structure will actually hold as a strong historical demand and support area and continue to act as support and demand. And second of all, it increases the probabilities that we will have a liquidity trap and retail traders will have their stop losses hunted before then the market reverses to the opposite side. Now, if we take this real chart example and we look at the data for the AUD, the first thing that we have to keep in mind is AUD is already AUD USD because all currencies on the spot are traded against the USD. And we can see, in fact, from the net positioning that institutions were already moving back to the bullish side for AUD USD. We were going from minus 77K net positions to minus 63K to minus 58K, minus 54K. So essentially institutions were slowly building up their long positions because they cannot just all at the same time add their positions. It's usually a gradual thing because they have such massive orders. So institutions were already starting to move back to the bullish side inside of this horizontal price action. Then we had the massive spike to the downside. We had all the stop losses get triggered. All retail traders which had their stop losses below these lows got liquidated. And only at that point, the real push to the upside actually started, creating what is commonly referred to as a liquidity trap or market manipulation. Stop loss hunting is pretty much all the same concept. Now, the question is, how can you take advantage of that, right? That is what we wanted to speak about in our last point. Well, if a level of structure, let's say, for example, this one here on a daily time frame, gets a liquidity trap and essentially some stop loss hunting, usually after that, the market reverses to the upside quite aggressively. So the concept is quite clear, and there certainly is the possibility to also develop a strategy behind that. If there is a strong level of demand and support, which continues to be tested as support, and institutional positioning is building up, and then we get a liquidity trap, the market drops, all retail traders with their stop losses below the support get taken out of the market, and then the market reverses to the upside. Usually what follows after that is a retest and massive rejection to the upside, especially if that institutional positioning is continuing to increase and institutions are continuing to move to the bullish side for the pair. So as usual, that pretty much depends on how you want to incorporate this into a strategy. There's a lot of work when it comes to building a strategy with clear set of rules, but this is definitely something that continues to happen over and over again in the market. And if you are in your stage of developing a strategy, it's definitely something that you might want to pay close attention to and try to build something around that, if obviously it fits your own trading style. Now, if you want to learn more, I really recommend that you go and check out my website, which is linked in the description, because what you see me share here on YouTube is actually just the tip of the iceberg. In fact, if you head over to the website in the description, you will have the possibility to join the best trading program on the planet. You will gain access to all the courses ranging from the very basics of charting all the way to the more advanced topics like building automated trading strategies using the MQL4 programming language, building portfolios of strategies using quantitative finance tools like the Quant Analyzer, and much more. You will have the possibility, in fact, to gain access to the trading station software with the Telegram notifications integration, one-on-one private mentoring directly with me, the COT data software, which often you see me use directly in my YouTube videos, on all my platforms actually. And if you scroll down, you will see that you also have the possibility to get the integration. So all my EAs, which you find here presented one by one directly on the website. And you also have the possibility to gain access to my live trading show. So I live stream of all the trades on my live account as they're opened, closed, trade, and obviously managed. And if you continue to scroll down, you will see that you have the possibility to join just after here the testimonials and gain automatically access with the email and password that you will create during the checkout process. So I really suggest that at least you go and check it out. The link is in the description and I will see you in it. If you enjoyed the tutorial, make sure that you click on the like button to support the channel. Also, let me know in the comments below if there are any new topics that you would like me to cover in my next videos. Also, subscribe to the channel so you never miss new updates, and I will see you in my next tutorial.